Tax-effective super strategies sounds boring, right? But getting this right could save you thousands in tax and add years of comfortable retirement. Today, we're breaking down the key moves for the 2025 to 26 financial year, from last-minute June 30th tips to long-term set-and-forget approaches. Core philosophy. Here's the thing, Super is a phenomenal tool, but it should align with your long-term financial goals, not just be a short-term tax play. Yes, we'll talk about lowering your tax bill, but the real winner is using these strategies consistently to grow your retirement savings. Contribution caps. First, understand the speed limits. For 2025 to 26, the concessional or pre-tax contribution cap is $30,000. That includes your employer's super guarantee and any salary sacrifice. The non-concessional cap is $120,000. Go over these without planning and you'll pay extra penalty tax. So stay tuned for the carry-forward rule. It's a game changer. Last-minute move. Lump sum deduction. If you're watching this before June 30th, you can still act. Make a personal lump sum contribution to your super, then claim it as a tax deduction. This lowers your taxable income for the year. It's a short-term fix, great for a surprise capital gain or bonus, but it's not a long-term plan. Spouse contribution offset. Here's a win for couples. If your spouse earns less than $40,000, you can contribute $3,000 after tax to their super. You get a tax offset of up to $540. This helps balance retirement savings, especially if one partner took time out of work. It's not just tax smart, it's relationship smart. Long-term strategy, salary sacrifice. Now for the heavy lifter, salary sacrifice. You ask your employer to send some of your pre-tax pay into super. Instead of paying your marginal tax rate, say 32.5%, 37%, or even 45%, you pay just 15% inside super. And it's set and forget. Consistent contributions compound over decades. This is the strategy I recommend to almost every employed person. Carry forward rule. What if you missed years of contributions? If your super balance is under $500,000, you can use unused cap amount from the previous 5 years, for example. If you only use $20,000 of your cap in 2000 to 21, you can add that unused $5,000 to this year's $30,000. Perfect for catching up after parental leave, study, or low-income years. Government support, co-contribution, and LISTO. If you're a low to middle income earner, the government will literally give you free money. Earn under $62,488, make an after-us tax contribution, and the government adds up to $500 as a co-contribution. And if you earn under $37,000, the low-income super tax offset, LISTO, refunds up to $500 of the tax paid on your employee contributions. Check your eligibility. It's often missed. Retirement calculator tool. Guessing doesn't work. Use a retirement calculator. The Australian Retirement Trust has a good one, and I'll link it below. Input your current super salary sacrifice amount and see the long-term impact. Seeing the numbers often motivates people to contribute more. Common mistakes to avoid. Quick warning, 3 big mistakes. 1. Exceeding the cap without using carry forward. 2. Forgetting to lodge a notice of intent to claim form with your super fund if you want a tax deduction. And 3. Putting money into super that you'll need before retirement age. Remember, it's locked away. Final summary. So to wrap up, short-term moves like a June 30th lump sum can help your tax bill, but the real wealth is built with long-term strategies, salary sacrifice using carry forward, and spouse contributions. Super isn't just a tax trick, it's your future. Which of these strategies fits your situation? Let me know in the comments. Don't forget to like and subscribe for more Australian finance breakdowns. I'll see you in the next video.